What if the most profitable part of your portfolio wasn't a stock or a government bond, but an investment you've probably ignored? Stick around and I'll show you 5 hidden gems in the U.S. investment markets that could make your portfolio work harder for you. Let's start with corporate bonds. Most people think, aren't corporate bonds risky compared to government bonds? Well, sure, some can be. But here's the key. Focus on high-grade corporate bonds from companies with stellar credit ratings like Apple or Microsoft. I remember Peter Lynch's advice from the 80s, stick to companies you know. Now, these aren't junk bonds. They're the corporate bond world's equivalent of blue chip stocks. Corporate bonds offer higher returns than treasuries, and here's the kicker. They're predictable. Unlike stocks, you know exactly what you'll earn if you hold until maturity. Personally, I like to buy corporates with an A1, A+ rating or higher, and I never have more than 20 to 25% of my holding in corporates. For my treasuries only followers, consider dipping your toes in the water with shorter, high-grade corporates, something AA or higher, with a 2-year or shorter maturity, and see how it goes. This investment is twofold. First, it gets you a little better return without taking a huge risk. Second, it gets you comfortable with corporates over the course of the next couple of years. You'll learn how to track your bond versus the general market and treasuries. Now on to preferred stocks, the best of both worlds. Maybe you've thought preferred stocks sound complicated. Why not just stick to regular stocks? Preferred stocks are actually simpler than you think. They're like bonds in that they pay fixed dividends, but they're traded on the stock exchange like equities. They're ideal for investors looking for income but willing to take on slightly more risk than bonds. A fun way to think of them? Preferred stocks are like the middle child of the investment world. Not as wild as stocks, not as reserved as bonds, but always reliable. This would be a nice addition for folks who are already completely comfortable with owning stocks and owning corporate bonds. These are particularly interesting to those trying to generate maximum income, but like adding a little more risk to their portfolios. Preferred stocks are a nice addition to portfolios looking for some additional risk diversification. One nugget that a lot of investors aren't aware of is in most cases, preferred stockholders get priority over common stockholders in cases where an issuer goes belly up. The priority is corporate bondholders, preferred stockholders, and if there's any money left, common stockholders will get the remainder. Let me know in the comments below if you'd like the channel to do a deeper dive on preferred stocks. For those of you that are still skeptical, in 2008, during the financial crisis, savvy investors who stuck with high-grade corporate bonds saw their investments pay off handsomely when the market recovered. Take General Electric, or GE, for example. While its stock plummeted, its corporate bonds continued paying interest, and those who held on were rewarded. The lesson? Even in turbulent times, these overlooked investments can provide stability and returns. Let me be perfectly clear. I'm not suggesting you move all of your investments into these 5 investments. I'm sharing these with you to offer some diversification alternatives that you may currently be ignoring. They're a great way to diversify some of your risks into sectors where you may not currently have any exposure. Enjoying these hidden gems? Don't let this video be the hidden gem of your YouTube feed. Hit that like button, subscribe, and let's keep finding ways to make your portfolio shine. Next up, real estate without the hassle. Think real estate investing is out of your reach? Think again. Real estate investment trusts, or REITs, let you invest in income-generating properties without owning a single building. You heard that right. Invest in real estate without being a landlord or getting that call at 3 a.m. about a broken furnace or air conditioner. The really interesting thing is, you can diversify within the REIT space because many of them are focused on one particular segment of the real estate market, like healthcare, retail, commercial office space, just to name a few. You can also diversify from the standpoint of where the real estate is located. Maybe you want a US-only concentration, or you'd like some global exposure. You can probably find one that aligns nicely with your risk tolerances, just like you would with any other investment. I've even seen a mutual fund that focuses strictly on farmland. Here's the kicker. REITs can sometimes deliver higher yields than bonds or stocks. Plus, they're required to distribute at least 90% of their taxable income to shareholders. That's cash flow you can count on. However, in a lot of cases, if you don't need the income, you can set the dividends to reinvest and buy more shares of that REIT. Do some research on REITs currently in the market and see if you find something that fits your risk tolerance. I like REITs because they're a completely different type of asset for diversification. Real estate has proven for decades to be a profitable investment, but typically carries so many barriers to entry. You end up with a real estate investment that is managed by people who spend their working hours using their experience in real estate to help investors, like you and me, be more profitable. Like I said, it's just a really great way to diversify. Moving on to our next hidden gem, municipal bonds. Now I know what you're thinking. Municipal bonds are in no way hidden, but the simple truth is people aren't taking advantage of those low default, you had that right, low default, high return securities. It's my hope that bringing them to your attention will get you to reevaluate how they can fit into your portfolio. Want to keep more of what you earn? Municipal bonds are the way to go. These are issued by local governments, and the best part, the interest is often tax-free, especially if you're investing in bonds from your home state. How many times have you done your taxes at the end of the year and been punched in the face because of your success by Uncle Sam? I know I have. However, I've also seen all of the interest I've earned on my municipal bonds get reported on both my state and federal returns, but not factored into my adjusted gross income, or AGI. From my experience, that's a really awesome feeling. If you're in a high tax bracket and not investing in munis at all, you are unnecessarily reducing your total return, specifically your after-tax return. Also, if you're in a high tax state like California, New York, Massachusetts, just to name a few, you're giving up even more of your investment returns by not investing in munis. And our fifth hidden gem can be found within this hidden gem. Got the bulk of your investments in tax advantage accounts and thus tax-free municipals just don't make sense? But you'd sure like to buy a bond at a somewhat higher return than a U.S. Treasury that has a really low risk of default? Then you'll want to look into taxable municipals. Taxable munis have higher returns than their tax-exempt cousins and U.S. Treasuries. They have better call protection than U.S. agency bonds and aren't as risky as corporates. Taxable munis really are the hidden gem of hidden gems. I traded them for many years and own some of them myself. That's quite the ringing endorsement, so check them out. But they can be hard to find sometimes. On Fidelity, once you're in the bond offering search tool, you'll go to the municipal bond section, and at the very bottom, you will see the section that is on your screen now, under Other Features. And at the top of that section, on the left, is a selection box that says Exempt from Federal Tax. To find the taxable municipals, you'll want to change that to No, like we have it highlighted in yellow on the screen. And on Schwab, you'll want to look in the Municipal Bond Search tool, the very top on the right. There's a field that says Federally Taxable, and you'll want to make sure that it's set to Yes, just like you see on your screen now. So many people have spent years on these platforms and never realized this was an option. It's a whole new world you've probably never seen before, so go check it out. Here's a bonus feature, an emerging trend, if you will, social purpose investing. Have you heard of green bonds or housing bonds, or perhaps you've heard of the exchange-traded fund VETZ, symbol VETZ. These are investments issued to fund environmental projects, housing availability projects, support to veteran home and business ownership, just to name a few. Not only do you earn a return, but you're also investing in a favorite cause. This style of investing is gaining traction as companies and governments prioritize things like sustainability, dealing with the housing shortage, and other causes. Example, Apple issued $4.7 billion in green bonds to fund clean energy projects, and they're delivering returns for investors. Also, Academy Securities issued an ETF with the symbol VETZ, which according to Academy Securities' website is the first publicly traded ETF to primarily invest in loans to U.S. service members, military veterans, their survivors, and veteran-owned businesses. The thing to keep in mind with all of these social purpose investments is that you should expect your returns to be lower as the investment managers are limited in their investment options, which can limit their upside potential. But in a lot of cases, these causes are so important to these investors that they're willing to give up some of their returns for the societal impact. Here's a personal investing tip. When exploring overlooked investments like these, always evaluate the credit quality, yield, and liquidity. For corporate bonds, stick to investment grade ratings. For REITs, look at the sectors they're investing in. If you're concerned about one of them, maybe the single family mortgage, stay away from them. Preferred stocks? Make sure the dividend coverage ratio is solid. The better you understand the risks, the smarter your decisions. My professional tip? As a 30-year bond trader, here's my advice. Diversify within the overlooked investments. Don't just load up on one hidden gem. Combine corporate bonds with REITs and munis to balance risk and reward. This approach creates a steady flow of income with less volatility for your overall portfolio. This is normally the point in the video where I place a call to action for your next steps, but today I'm going to do something a little different. I'm going to share with you my next steps. Real estate investment trusts are an overlooked investment for me and my portfolio, so I'm going to do some research on them and see if I can find some that makes sense for me. I hope you'll do the same with one or two of these investments. Go out and do some research and see what makes sense for you. If you're ready to learn more about corporate and municipal bonds, check out the videos on your screen now as introductions to these two types of bonds. Don't miss them. They're packed with insight for smarter investing. Always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. Please see the description for the full disclaimer.